In this grade 12 economics video, we are looking at dynamics of markets. Particularly in this video, we are going to focus on the perfect markets, or rather the dynamics of perfect markets. We are going to look at perfect competition, and then we are also going to look at normal profits. By normal profits, we are basically talking about the normal profits, or rather the equilibrium graphs. So we are going to get into how to interpret those graphs, how to draw them, and what to look for when you're looking at those graphs. In the end, we are also going to have a question that we are going to look into that is pertaining to the section of dynamics of perfect markets. We are going to have a couple more videos that will come after this ones that are going to focus on other market structures like your monopolistic competition, oligopoly, as well as monopoly. So let's go ahead and get started with our perfect markets. First, we need to understand what are perfect markets. So in this section, we are going to be looking at what do we mean by perfect markets. A perfect market is a market that has perfect competition. So this is the basic description of what a perfect market is. You cannot describe a perfect market without talking about perfect competition. We know as market structure is perfect market if it is characterized by perfect competition. So when you look at our different market structures that we have just briefly mentioned, we are seeing that the first market structure there is called the perfect competition. This is where you find the perfect market. It has many buyers and sellers. It sells homogeneous product. The market entry is completely free. There is no control over price. It has complete information, and its examples include international commodity market like gold markets and oil markets. So that was just a brief description of what a perfect competition is. But in this section, I want us to look at perfect competition in detail. So what is perfect competition? So perfect competition occurs when there is a large number of participants. By a large number of participants, we mean the number of buyers and sellers that are in the market. So anytime you enter a market and you find that there is a very large number of buyers and sellers in that market, that's what we call it a perfect competition, because it means that it's fair game for anybody. The competition is free. There is also complete information about the marketplace, so meaning that there is no gatekeeping in the marketplace. There are some markets where there is the information is incomplete, meaning that if you wanted to enter such a market or such an industry and start a business selling whatever product that they are selling in that market, it is not anybody who can do it, because the information on how to do that is something that is hard to acquire. So think about, for example, if you wanted to start a business right now of a cell phone network, like to compete with your MTNs and Vodacoms and Telcom, not many people has the information on how to go about starting such a thing and registering as such a thing. It is unlike when you wanted to start a fast food business. When you want to start a fast food business, the information, we can say that it is completely free, because you know what to do, you know where to go, you know what's what. But when you start a business like a cell phone network, the information on it is not completely free. And then lastly, it says that, and where the prices are determined by demand and supply. So the prices that you're going to set, they're not going to be determined by one business. It is the demand and supply that tells you what the price is. So with all of that being said, let's look at more of the characteristics of the perfect competition. The first characteristic of perfect competition is that they sell what we call homogeneous product. Homogeneous product just basically means that they are identical product. They are exactly the same thing. They're the same quality, same quantity, same style. So you will find them exactly the same. That's what we call a homogeneous product. So that gives us perfect competition, because you are not selling a better product than the other person. You and the firm next to you, you are both selling the exact same thing, and that's what makes it perfect competition. Then secondly, there is a large number of participants. Like we said before, there is a large number of buyers and sellers, meaning that there are a large number of people who are supplying that same product, and there's also a large number of people who are demanding that product. Then the number 3, there is no collusion, meaning that there is no firms that are working together, or no more two businesses that are working together to come up with strategies to eliminate other competition. There is no collusion of price, determining the prices and gatekeeping the price, or working together to beat out the competition. Businesses are not working together, they are working as individuals, they are not colluding on anything. The fourth characteristic is that there is free competition, meaning that there is no interference by the government, there is no price control either. So that means that, like we were saying with collusion, there is nothing that is controlling the prices. There is situations where the government can intervene to control prices, where they will tell you that these are basic goods, and because they're basic goods, they should be sold at a lower price. There is also a price control that can come from collusion by two businesses colluding. There is also a price control that can come from customers forming groups together. In a perfect competition, all of those things do not exist. There is free competition in that all of those things that could force the price to be controlled or cause the price to be controlled, they do not exist. Competition is completely free. Every business is a standalone business. You can enter a business as a newbie and you will compete at the same level with the other businesses that are also that have been in the industry for a long time. Why? Because the competition is free and there is no government regulation that is going to stop you from running your business. Characteristic number 5 is that there is efficient transport and communication. By efficient transport, we are meaning that the transportation or the logistics of moving products to every part of the country are efficient, in that every part of the country is able to get that sort of product. That means that because in some instances, if transportation is not efficient, so for example in the rurals, you will find that in most rurals some things are expensive. Why? Because of it is hard to get those things to the rural areas, or those things are scarce in the rural areas, and that scarcity causes the prices to go up, because when something is scarce, it causes the prices to go up. So the efficiency of transport eliminates that problem of making things scarce. So it basically allows a product to move with ease from any part of the country, which makes the prices to still stay the same. Similarly with the communication, there is no gatekeeping of information, so the information is complete and it is free. And then we also have free entry into this type of market, meaning to start such a business will be easy. Next, we are going to get into the graphs in perfect competition. So we are going to look at interpreting equilibrium graphs. The first graph we are going to look at is a graph that exists if the businesses that are in this perfect competition or the perfect market are making a profit. So if the businesses in the perfect market are making a profit, how will that graph look like? So let's look at the y-axis, meaning the vertical line. In the vertical line, we have unit revenue or cost. So basically, these are where your prices are going to be, whether it's the price of revenue or the price of cost, or the selling price and the cost price. So that's where they're going to lie. So you are seeing C1 is basically going to be our cost. So the cost to produce or to stock goods, they're going to call it C1. And then P3 that you're seeing there is going to be our price, or rather our selling price. So you are seeing that the profit is going to lie in that gray area where the cost, the price, the selling price rather, is higher than the cost. So that's what you're looking for. That is your first indication of that you are looking at a graph that represents an economic profit. The cost is going to be lower than the price. So then we are also looking at the quantity at the bottom. The quantity is going to be the amount of units that we have produced and the amount of units that we are selling. So here we are just dealing with Q3. So our quantity is at Q3. And then you will see we have an equilibrium where our quantity meets our price at P3. That's where we have equilibrium 3. Why at P3? Because you are seeing that the graph at P3 is the average revenue, which is equals to the marginal revenue graph. Even when we are looking at it at a loss, you will see that at P3 we still have our average revenue, or that is equal to our marginal revenue. But you are seeing that you know that you have a loss because now the C has gone above the P, meaning the cost is above the price. So the moment you have your cost above the P3 line, which is the average revenue that is equal to the marginal revenue graph, that tells you that you are making a loss because basically you are saying that your cost is higher than your revenue. So when we are talking about, just to explain the average revenue and the marginal revenue basically means the revenue that you earn from selling one unit. That's what marginal means. Marginal means you're looking at one unit. So marginal revenue means the income from selling one unit. In this instance, it's going to be the same thing as the average revenue. Average revenue basically is there are, and between the spectrum of what you can sell, at average what are you selling. So for most firms you will find that their average is equal to the selling of one unit. Hence you are seeing average revenue is equal to marginal revenue. What's most important here, what indicates that you are dealing with a loss, is that your cost is going to be above the average revenue and the marginal revenue graph. Hence even your marginal cost and average cost are above that line. What you are aiming for in a perfect competition is that for you to stay afloat in that market is what you are aiming at, making normal profits. So making normal profits meaning that you are aiming to operate at an equilibrium. What is an equilibrium? The equilibrium is where the graph, you will see that the cost and the price are going to be represented by the same graph. So look at that. It says C2 is equal to P2, meaning the cost is equal to the price. Because at average revenue, which is equal to marginal revenue, that line, that's the graph of our average revenue and marginal revenue. Now look at the average cost graph. The average cost graph, as it curves, you will see that it curves right on top of the average revenue graph. So that means that my average cost and my average revenue are the exact same amount. Similarly, you will see that the marginal cost graph passes through the marginal revenue graph at exactly the same quantity, which is at Q2. And this is what we are looking for to say that you are making normal profits. Basically that point there where it says MR is equals to MC, that means your revenue is equal to your cost. That's what we call an equilibrium, or the break-even point. So break-even point basically means that at Q2, what you have spent in terms of cost and what you're going to receive in terms of revenue is going to be the exact same amount. So for you to start making profit, it means that you need to produce more than Q2. So that means that you need to create yourself a Q3 that's going to push a little bit further. So when it pushes a little bit further, that means that you're creating more, and that more is going to create for you a profit. But if you create less than Q2, that means then you are going to be making a loss. So your equilibrium shows you where you need to go for you to be able to make profits. But it is possible that things can get so worse that they get to a point of a shutdown. So let's look at where is the shutdown point. A firm will shut down if it cannot meet its average or total variable cost. So meaning that you are not able to cover your average costs. That way we are basically saying that this is the point where your total revenue is going to be less than your total variable cost, or your average revenue is going to be less than your average variable cost. Remember, at average, we are basically finding the approximate point in the middle, whereas with total, we are basically saying the actual total of things. So whether you are dealing with the middle estimate or you are dealing with things in totality, if the revenue is less than variable cost, you have reached the shutdown point, because at that point it means your business cannot sustain itself any longer. It cannot pay for its basic cost to stay operational. So when looking at a graph, you're interested in proving those statements true for you to, so that you are dealing with a point of shutdown. So basically our statement said you shut down, or a firm shuts down at a point where total revenue is less than total variable cost. So looking at the graph that we are looking at now, we do not have any total revenue and total variable cost, but what we do have is average revenue and average variable cost. Remember, it said the same thing about those two. You have shut down where average revenue is less than average variable cost. So look at my graph. At P3, find P3. At P3, I have my average revenue. So because my average revenue is at P3, what I'm expecting is that my average variable cost needs to be below that line. But as you are seeing that my average variable cost is actually at P2, and that is above P3. So this graph is a good representation of what a firm that needs to shut down looks like, because its average variable cost is above the point at which it's making its average revenue. So we are making average revenue at point C. So point C, that is the price at P3 and quantity Q2. That's giving me my average revenue. But my cost is all the way at P2 and Q3. And that means the firm needs to shut down. So because of such complexities, there ends up being what we call competition policies. The purpose of competition policies is to ensure that there is fair competition. The competition may not always be perfect because there are other market structures that exist. We have talked about monopolistic competition, for example, and your oligopolies, and because of those, they are out there. So in some markets it becomes impossible to have perfect competition. But even if the competition is not perfect, it can still be fair. And that's where competition policies come in. The competition policies basically are enforced by what we call competition institutions. These are institutions whose main aim and purpose is to ensure that they guarantee fair competition. So the first institution that guarantees fair competition is the Competition Commission. The Competition Commission basically investigates restrictive business practices, abuse of dominant positions, and measures in order to achieve equity and efficiency in South African economy. So basically, they investigate any business practices that are too restrictive to a point where they are restricting other businesses from being able to participate in the market as they should. Then we also have the Competition Tribunal, which says it has jurisdiction throughout the Republic, meaning in all of South Africa. It is a tribunal of record and independent from other competition institutions. The tribunal's main function are to grant exemptions, authorize or prohibit large measures. By measures, by the way, we are talking about where businesses would collude among themselves. So to prevent things like collusion. Remember, we said one of the characteristics of the perfect competition is that there is no collusion. So these measures, there are some businesses that will say we are merging our businesses, when they actually just mean that they are colluding to ensure that they are gatekeeping the industry or they are trying to control prices. So the tribunal is there to make sure that such things do not happen. They also adjudicate if any misconduct takes place, issue an order for cost or matters presented to it by the competition commission. So it basically goes further than what the competition commission does. Lastly, we have the competition appeal court, and its main function are to review orders made by the competition tribunal and amend or confirm these orders. So that means that the competition tribunal reports to the competition appeal courts. Now let us look at an exam question to put to test everything we have learned. The full question paper is linked in the description box below. We are in question 3.3 of our question paper, and it says study the graph below and answer the questions that follow. We are seeing that we have a perfect market graph. We are seeing that we have price and we have quantity. We are told that at 10 rands we have our marginal revenue, so that means that 10 rands is our income. Then we are also looking at 12 rands. The 12 rands is right at, you seeing at letter A there, we are seeing that it's a average total cost. So that means that we are making a revenue of 10 rands, but our cost is 12 rands. Point B becomes then our shutdown point, because that's where our revenue is, and you are seeing every cost is literally above it. So our first question in 3.3.1 says identify what is represented by point B in the graph. We have already said this. The point B, at point B, we are having our shutdown point. Why? Because that's where our marginal revenue is, and all of the cost, our average cost, total average cost, all of them are above that line. So that becomes our shutdown point, because it means that at that point we are making less than a loss. So that becomes our shutdown point. At 3.3.2, it says what is the cost of producing 1 unit according to the graph above. So 1 unit, remember I said to you, marginal means that we are dealing with the cost of 1 unit. So, and our graph shows us 12 rands as our marginal cost. How do I know that it is a marginal cost? It's because the 10 rands I was told was a marginal revenue. So the revenue can't be marginal and the cost not be marginal. So if 10 rands is marginal, that means that the cost is also going to be marginal. So the 12 rands is also a marginal cost. Then in 3.3.3 it says briefly describe the term variable cost. So basically, what is variable cost? What are we talking about when we are talking about variable cost? So in a firm we have two different types of cost, the fixed and the variable. The variable is basically costs that change with the level of output produced, whereas fixed costs do not change regardless of the level of output that is produced. So average cost, basically it depends on the number of units that we have produced. So when I have produced 10 units, my average cost is going to be different from if I produced 15 units and if I produced 20 units. So it depends on the level of output that is produced. 3.3.4 says explain the condition that must exist for a firm to shut down. We had already mentioned too, we said it's where total revenue is less than total variable cost, or average revenue is less than average variable cost. So either one of those you can give. I gave the first one, total revenue must be less than total variable cost. Or in other words, you can say where a firm is unable to cover its variable cost, because that's what that statement means. If total revenue is less than total variable cost, it basically means that we cannot cover our own variable costs. 3.3.5 says calculate the economic loss made by this firm, show all calculation. As we have already established from the graph that we saw, we are dealing with a loss because why? Our revenue of 10 rands is less than our cost of 12 rands. So that's where we start. We are going to say that our revenue of 10 rands minus 12 rands as our cost, that's going to give me a loss of minus 2 rands. Then I'm going to multiply that with the units. The units is basically the quantity. I got it on the x-axis of our graph there. And so when I multiply -2 with 200 units, that's going to give me a total loss of -400 as my loss. The next thing you need to cover is monopolistic competition, and that is going to be in the next video, so go make sure that you are looking for those. In that video, we are also going to be doing more questions that are going to pertain to monopolistic competition, and then from there we will be moving to other market structures like monopoly and oligopoly, as well as market failure. Now, if you need one-on-one help with anything that we have covered in this video or this subject in general, we have a visual program that can help you with just that. From anywhere in the country, all you need is an email and a WhatsApp, and we are able to give you personalized help for a monthly fee. This will cover full lesson recordings as well as notes and study materials for any of your subjects that you need personal help with. This will include some of the subjects that are not even covered on this channel. For example, subjects like history. You will soon see our full subject list. We will also cover scopes for those specific subjects as well as attempt past papers together. But what's most important about these virtual sessions is that you get full-time communication, meaning from the hours of 8 o'clock to 4 p.m. you are able to send in your questions. Even if you send them at late, between the hours of 8 and 4 you will get replies to your questions. You will get to go back and forth and get full-time attention on any question that you do have. Even if we have to repeat something over and over again, you get to have that personalized help that is helpful to you. As you can see with some of the examples there, we get to exchange scripts, we get to exchange question papers, and you get to show me what it is that you wrote, and you even get markings for your questions to see how you actually do perform when it comes to a specific question or a specific subject. Grade 10 to grade 12, as well as those who are upgrading and rewriting, those are the full list of subjects that we do offer. If you are interested in any of this, for you to be able to get your price quotation, it is very simple. All you have to do is email me on that email address that you see there. When you do email, make sure that in the subject line you write your name and surname, and then in the body of your email, that's where you will tell me your grade and the subjects that you need help with. It can be one subject or it can be a mixture of subject. Hence, we are saying that you need to email for you to be able to get your price quotation. Now, because this is one-on-one, it means that it puts a limit on the number of people I can take per month. So I'm going to be limiting it to 10 students per month. So make sure that you email to secure your spot. Have YouTube recommend you more of my videos, be sure to click the like button and subscribe to the channel. And if you have any questions, leave them in the comment section below.